The markets are in free fall. A sea of red engulfs trading screens worldwide. Investors are staring at losses, stunned by the speed and ferocity of the downturn. What triggered this financial earthquake? The answer is simple: tariffs. President Trump's Liberation Day tariffs, intended to protect American interests, have backfired spectacularly, igniting a global trade war and sending markets into a tailspin. This isn't a minor blip. We're talking about trillions of dollars in losses vanished into thin air in just 3 days. The Dow Jones Industrial Average, a bellwether for American business, has plummeted over 4,000 points. The tech-heavy Nasdaq has entered bear market territory, a clear sign that investors are bracing for a prolonged downturn. The fear is palpable. From Wall Street to Main Street, the sentiment is the same: uncertainty. No one knows how long this downturn will last, how deep the damage will be, or what the ultimate consequences will be for the global economy. One thing is certain: we're in uncharted waters, and the journey ahead is fraught with risk. President Trump's trade war escalation was the catalyst for this market meltdown. The Liberation Day tariffs, announced on April 2, 2025, slapped hefty levies on a wide range of Chinese goods. The administration argued that these tariffs were necessary to protect American jobs and intellectual property. However, the move was met with swift retaliation from Beijing. China, in a tit-for-tat response, imposed its own tariffs on American products. The escalating trade war has injected a dangerous dose of uncertainty into the global economy. Businesses are wary of investing, consumers are holding back on spending, and the threat of a full-blown trade war looms large. The back-and-forth tariff threats have created a climate of fear and instability. False reports of a potential tariff reprieve briefly offered a glimmer of hope, sending stocks surging before plummeting again when the White House denied any such plans. This volatility underscores the fragility of the current market sentiment, easily swayed by rumors and speculation. The numbers tell a chilling story. A staggering $9.5 trillion has been wiped out from global equity markets in just 3 trading days. This is not just a number on a screen. This represents real losses for investors, pension funds, and ordinary people saving for retirement. The Dow Jones Industrial Average, a closely watched barometer of the American economy, has experienced its largest intraday point swing ever, a staggering 2,595.24 points. The S&P 500, a broader measure of the market, has suffered its largest intraday swing since the dark days of the 2008 financial crisis. Oil prices, a key indicator of global economic health, have also taken a nosedive. U.S. crude has tumbled to $60.70 a barrel, while Brent crude has fallen to $64.21 a barrel. This decline reflects fears that the trade war will dampen global growth and reduce demand for energy. Section 4. Global shockwaves. From Asia to Europe, markets reel. The shockwaves from the trade war and the ensuing market turmoil are being felt far beyond Wall Street. Asian markets were the first to react, with the Japanese Nikkei index plunging by almost 8% and the Hong Kong Hang Seng index plummeting by over 13%. European markets followed suit, with the Pan-European Stocks 600 index tumbling by more than 6% and Germany's DAX index falling by 7%. The synchronized global sell-off is a testament to the interconnectedness of the global economy. Investors are clearly worried. They are seeking safe havens for their money, such as U.S. Treasuries and the Japanese yen. These assets are seen as less risky during times of economic uncertainty. However, even these traditional safe havens are showing signs of stress, with U.S. Treasury yields rebounding after an initial fall. Section 5. Recession fears grip investors. Experts issue stark warnings. The market turmoil has ignited fears of a global recession. J.P. Morgan Chase, one of the world's largest banks, has raised its recession risk forecast to a staggering 60%. This is a significant jump from their previous forecast, and it reflects the growing concern among economists that the trade war could tip the global economy into a downturn. BlackRock CEO Larry Fink, who leads the world's largest asset manager, echoed these concerns, stating that most CEOs he speaks to believe the U.S. is already in a recession. This sentiment is shared by many analysts, who warn that the tariffs will inevitably lead to higher prices for consumers, reduced business investment, and slower economic growth. The International Monetary Fund, or IMF, has also sounded the alarm, warning that the trade war is a serious threat to the global economy. The IMF has downgraded its global growth forecast for 2025 and 2026, citing the trade war as a primary factor. Section 6. A glimmer of hope, seeking refuge in uncertain times. Amidst the market carnage, there are a few glimmers of hope. Some market sectors, such as technology and consumer staples, have shown relative resilience. Certain tech stocks like Alphabet and Amazon have even managed to eke out gains, suggesting that investors still see value in these innovative companies. Moreover, the flight to safety has benefited some asset classes. U.S. Treasuries, despite some volatility, remain in high demand as investors seek the relative safety of U.S. government debt. The Japanese yen, another traditional safe haven, has also strengthened against other major currencies. These pockets of strength suggest that even in the face of extreme uncertainty, investors are still seeking opportunities and havens for their capital. The market's ability to differentiate between sectors and asset classes suggests that a nuanced approach, rather than outright panic, is warranted. Section 7. The Road Ahead. Navigating the Storm of Volatility. The road ahead for the global economy and financial markets remains highly uncertain. The trade war, if it continues to escalate, has the potential to inflict significant damage on global growth and corporate profits. Investors should brace themselves for continued volatility and uncertainty in the coming weeks and months. However, it's important to remember that markets are cyclical. Downturns, however painful, are a natural part of the economic cycle. History has shown that markets eventually recover, even from the deepest of crises. In the meantime, investors should remain calm, stay informed, and avoid making rash decisions. This is a time for prudence, not panic. By focusing on long-term investment goals and maintaining a diversified portfolio, investors can weather the current storm and emerge stronger on the other side.